This is Daryl, and this is the first video, and I'm going to be explaining divergence and trading with divergence in this video. Now up here you'll see I've got my cheat sheets up, and my cheat sheet shows me the 4 different types of divergence. The first one, bullish divergence, and you can read that by looking at the swing points. The swing points being here and here, and these from this swing point to this swing point, price is going lower. The bottom of the chart, from this swing point to this swing point on the oscillator, it's going higher. So that would be standard bullish divergence. Over here is bearish divergence, and we have higher price going higher and from one swing point to the next, and on the oscillator price is going lower from one swing point to the next. Hidden bullish divergence, which is supposedly just the opposite, but the way to read this is on the bottom we have price going from a low to a high, and on the bottom on the oscillator we have price going from a high to a low. And hidden bearish divergence right over here, price on the top going from this swing point to this swing point, going lower on price and going higher on our oscillator. So I always keep these charts or this screenshot available of this chart, so I don't have to try and remember all the different iterations of this, because it can be very confusing, particularly if you're new new to this. So I will leave a link to this so you can download it. And let's get onto the chart here, and I'll demonstrate a couple of these. So first, over here we have a euro dollar excuse me, euro dollar 4-hour chart showing divergence and several different places pardon me, and these several different places we can use our cheater chart over here to figure out what it is. The first one is our standard bullish divergence, with price going lower on the chart and higher on the oscillator. Okay, so from here, what do we do? Okay, so we find the real low point right down here on the oscillator before it starts to go up, and we use our crosshairs to determine what that price is over here on the stochastic. I don't know if you can read this, it might be too small a print depending on what size monitor you're using, but this is called the data window, and I always leave this open because otherwise my only option is to read stuff down here, excuse me, down here in the very bottom, and this only gives you, gets right down, okay, in the very bottom next to this where it says market overview, and that only gives you price. It doesn't give you the oscillator settings at the time or the oscillator readings. So from this point being the low point, I'm looking for the next higher candle, which would be the one to the right of this. And then what I'm looking for from here is I'm looking for price to go higher from this point right about here. Okay, right about there. Okay, it says 105.76.9, we'll call it 77, which is the high here. Now I don't trade immediately on break of this high. I'll wait for the next candle to break by 3 to 5 pips, depending on what pair I'm trading. 3 to 4 pips on the euro dollar 4-hour chart would probably be plenty of room for price to travel up for me to become interested in possibly taking this trade. So in this case, my high here, if you can see it, read it on the left, right over here, okay. Price here is on our subject candle that we want to trade the break and the high is 105.77. On this one right here, the high is 105.84. So that's 8 pips, and I'm clearly would have gotten in on this myself. You may set other criteria for yourself. That's your choice. So that would be my entry. So where is my stop? That's the most important thing. Some of the discussion we had was about how many pips should you try and make in a day? Well, or how much money? That's not nearly as important as controlling your losses. So we should all think about our losses, and going into each trade assume that it's going to be a loss, even though we may do our best analytics to figure out where price is going to potentially go. However, if we don't take that into consideration and we have a tendency to overtrade, which is very common, particularly in traders that are learning, and you can be learning for years and still succumb to that. So have yourself a fixed number like say 1%, 2%. In no case would I ever advocate anything, really use anything over 2%, because even if you go to 3%, think about it this way: if you lose 10 trades in a row at 3%, you've lost 30% of your account. And can you lose 10 trades in a row? You certainly can. I've lost more than that in a row previously. That's why I rarely trade more than a 1% risk on any particular trade. And if you do say lose 30% and let's say your account is $1,000, you lose 30%, now you only have 700. So now it takes twice as long to get back to that 1,000 using whatever risk parameters you're used to using. If you're using a percentage, which I would recommend always using a percentage of your account instead of just a pip count, then it would take much longer at 3% to get back up there. A quick math here, and then I'll get on with this. But if you're using 3%, as a risk, and say 3% as a reward if you win, then 3% of 700 would be, okay, I got to do the math here real quick, that would be like $21. So if you had 10 wins in a row at $21, that would be $210. So now in the same 10 trades, you're still minus $90, because if you add 210 onto 700, then you have a total of 910, and it only took you 10 trades to lose 300. So see how that doesn't work out. So you need to keep those things in mind. And sorry for that long rant on that, but this is extremely important to think about these sort of things, because when you enter a trade, you're never right or you're never wrong. You either win or you lose. The market does what the market's going to do, irregardless of how impressed you are with the setup, how much you're certain that your setup is going to win. It doesn't matter. It doesn't matter. The market will take care of everybody. It does not care what you think. It does not care what the setup is. It just simply does not care. So please, I'll stop this rant right now, but keep that in mind. All right, getting back to this trade right here. Let's say we get in at 80, we'll call it 80. Okay, so 80 would be somewhere right around here. Then that's going to make our stop below here, and it's 63 pips here. I'd suggest using at least like a 4 pip buffer area down here, maybe even 5. So at 63, then we want to go to 68, somewhere right down below this last swing low. And then our target is going to ideally be at least that same, what was it, 68? Yeah, about 68. And it does, in fact, first it goes down here, so we have to suck it up and wait for a 42 pip drawdown. And then the price eventually goes up to this point over 100 pips. So we got our 1-to-1 here, but I would suggest also maybe thinking about more than a 1-to-1. And that's always a difficult thing to do, but on a 1-to-1, this would have been a pretty easy win. You see, it would have come in at 68 right about in here, but you would have had to wait for, let's see, this is a 4-hour chart, so you would have had to wait about 10 candles, 10 times 4, 40 hours, so almost 2 days for this to work for you. But I know there's a few of you that mentioned perhaps you don't want to scalp, you want to trade longer term because you have work, you have school, any number of things that can get in the way of trading. So go ahead and try this out on your daily charts, your 4-hour charts, and you could even try it out on 1 hour. I'm not convinced that 1 hour is going to do as well using this type of method. You can test it out for yourself. So that's what we're doing here. So to review this quickly, this was our low point candle right here, as marked or as determined by the low point right here on the low of the oscillator. And then the next candle gives us a higher reading on the oscillator. So, excuse me, I'm in the wrong one. This is the low candle, I'm sorry, this is the low candle right here. This one gives us our higher reading. And so we're looking for a break of this, the taller blue candle here with the long wick on the bottom. And we got that right here on our entry about, say, 3, 4, 5 pips above the high of this candle. We had some drawdown, and then it went up 105 pips when we had a stop of 68. You can handle this any number of ways. You can, at some point, maybe move your stop to break even when you're so far in profit, and instead of just having a fixed pip count for going so far in profit, you can do that, but you might want to look at an area like this right here, where price was hanging out here for quite a while and then it dropped all of a sudden. This creates over here, and I'll get into this in the next video more, this creates what's called a liquidity void. Let me get this thing out of the way. This creates a liquidity void that price doesn't like to be out of balance, and that's what this creates here. So it tries to get back up there. In fact, on this candle right here, it does get right back up to the point where it dropped from here. So this might be a good place to go to break even on your trade, and your break even is going to be right about here. And so you could have, depending on where your break even stop moved to, this candle right here may have stopped you out, but you wouldn't have lost anything. Okay, and in this case, they're all going to be different. Every trade is going to be different. However, if you would have maybe not moved it up that far from this point, excuse me, from your stop down here, maybe if you'd have just moved it up to the next kind of what I would call a demand area. Once again, I'll explain that further later on, which may be right about here, which is the place where price took off from to go up, then you would have still been in this trade. Price goes up about 100 pips. Okay, so that's going to be it for this. On Tuesday, we're going to try and do a session live that you can all join, and we'll go more into divergence, but this is just a little teaser on this. As you can see on a 4-hour chart, this happens all the time. At least, being a 4-hour chart, probably at least once a week on average for most pairs. Although right in here, there's a big area where nothing much is really happening along the lines of using divergence. So, but generally you're going to get a lot of trades on a 4-hour, and if you trade more than one pair, you probably are going to get at least 2 or 3, maybe 4 a week, maybe 5 in some weeks. It just depends. So that's about it for now, and I hope this was clear. Definitely send me questions if you have them.